Another great conversation. I have Sheila Bair of the FDIC and author of a couple of books. Her most recent one, How Not to Lose $1 Million. Sheila really has done more than just about anybody to facilitate financial literacy and education for not just adults, but young adults and kids through all of her writing. I thought this conversation was tremendous, and I think you will also. With no further ado, the former chairperson of the FDIC, Sheila Bair. Sheila Bair, welcome back to Bloomberg.
Thank you for having me.
So I want to start with a little bit of background from you. You get a bachelor's in philosophy from the University of Kansas and then go to law school at the same school, University of Kansas,
right.
Where you got a JD.
Yeah.
What was the career plan? Did you want to be a lawyer, or what were you thinking?
Well, I'm a native Kansan, grew up in southeast Kansas, traditional Kansas Republican family. We were all Jayhawks.
Mm-hmm.
Dad went to medical school at KU. Mom went to nursing school. My sister was a physical therapist. I didn't choose a medical profession, but did choose KU. So it's a good school. It was an affordable school. And I really didn't know what I wanted to do. I was interested in philosophy. I took a lot of courses in English and economics too, but majored in philosophy. And realized pretty much as soon as I graduated, I wasn't going to get a very good job with that degree. So,
well, you could always teach philosophy.
I could do that, but I would have to get a PhD and,
Right.
and probably go to school longer than I wanted to do that. So I decided to go to law school, which was philosophy is a good major if you're going to go into law school, because both disciplines are about logical thinking, analysis, good writing skills. And so actually the philosophy major was good preparation for law school.
Yeah, say the very least. So your career spans from government and academia and finance really at the highest levels across all three.
Yeah.
What's the through line connecting each of these worlds?
Yeah.
Government, regulation, academia, and finance.
Yeah. Well, I have been. I've done a lot of different things in my career, and young people, I tell them, don't try to pre-program your career and don't be narrow-minded about opportunities. And a lot of people stay in the same job for 30, 40, 50 years. I respect that. That's fine. That was never for me. I'm always looking for new things. But I guess my first entree to the big leagues, or at least adjacent to the big leagues, was when I worked for Bob Dole as his counsel, first on the Senate Judiciary Committee, where I staffed him on the Voting Rights Act compromise to Title II of the Voting Rights Act, which is pretty much just eviscerated by the Supreme Court, which was very, that was my first big project for him. So that hurts. But anyway, so I went to the leaders when I became majority leader. I went to the majority leader's office with them and handled a broader range of issues. But that's really, and then I was on his '88 presidential campaign. Actually, which obviously started in 1987, those campaigns start a good year before the primaries begin. And that's where I started off as a civil rights lawyer and did civil rights issues and other things for him. But we had the 1987 market crash during the time I was working for his presidential campaign, became a big issue. I had to take a crash course in stock markets, and that's when I was first exposed to finance and found that I was really interested in it.
Really interesting. And I want to focus on some of your writing because you've written for very different age groups, demographics.
Right.
So Bull by the Horns, obviously, for adults about the GFC. But the Money Tales book series is aimed at kids.
Right.
And then the new book is really aimed at teenagers, people starting out.
Right.
How different is it communicating somewhat complex ideas to each? Or is it the same? Is it just making it understandable? Or is it a different approach for each group?
It's a bit of a different approach. I think, that the fact that I didn't really start in finance, that I segued into it, working for the stock exchange, then later many other senior level jobs, I had to start from scratch when I was learning it, and I had to learn it fast. But I think my own experience helped me really break down and understand how to approach understanding finance. And one of the big issues is the terminology, the jargon that we use in the financial industry. And that can be very confusing and intimidating. And I think sometimes weaponized, frankly, by people who are trying to sell a product or service. So, but yeah, I mean, I think my early need to really start from scratch and learn it helped me later break down and explain things. And then I think also my philosophy major, the logical thinking, breaking things down into their component parts, understanding the causal connections, kind of laying it out, the analysis out for people in an understandable way, is something that I've always tried hard to do and have refined over the years. But yeah, Bull by the Horns was definitely, it was written for a general population, but it talks a lot about securitization and topics that might make some people's eyes glaze over, but for industry professionals, I think it was of interest. But my children's books, and actually I wrote another book for teens called Bullies of Wall Street, which was a book about the financial crisis for teenagers. And then I have, golly, since 2006, I've been as a sideline writing picture books for children. And those are really fun because those are fictionalized stories. I use rhyming verse. They're just fun. You can be creative because they're really about basic concepts, compounding interest, risk, capital formation. Those are things that really you can't explain at a very basic level for kids. Ponzi schemes is one of them. Asset bubbles is one. I wrote one. It's called Daisy Bubble. It's kind of a riff on the tulip bubble that occurred in Hollywood hundreds of years ago. And I was concerned that kids were not going to get this. And that's one of my more popular books, especially with the boys. There's a character named Sly Seal that's manipulating the daisy market. And I make that very transparent in the book, and they enjoy that.
That's very funny. My favorite part of Bull by the Horns is just the really vivid detail you go into with the clashes with Tim Geithner and Hank Paulson. If you could go back in time and magically change any decision that was made during the GFC, what was the wrong decision and how would you fix it?
You mean during the crisis or in the lead up to the crisis?
Either or. What do you think? What do you think the big issue? It's never one thing. But let's since I mentioned Geithner and Paulson, what of their decisions do you think was most problematic that you would have liked to reverse?
Yeah. Well, I think there should have been more accountability. I do think there should have been more accountability. I think
meaning bankers, Wall Street, that helped create the crisis.
We should have at least provided more financial penalties, even if we weren't going to send people to jail. I think the bailouts could have been less generous. I am still outraged that we let them pay bonuses at the end of 2009. So I think that was, after giving them all this capital. And then once they, got the benefit of all these other programs and, stabilized themselves to enable them to pay that capital back so they could pay bonuses at the end of 2009 when the rest of the country was reeling in a recession. No, I think we could have been a lot tougher. So, but, these things are all compromises. And actually it was more with Tim Geithner than Hank Paulson. Hank and I could usually come to a common ground, and we did on issues where we started with different viewpoints. But yeah, I mean, I think there is a perception of some that they were kind of the Wall Street was the center of the universe and the heartthrob of the economy, and we needed to take tender loving care with it and all of that. And we need to do something. I'm not suggesting we shouldn't have provided some stabilization measures, but we didn't have to. I think we really went overboard, and I do regret that. And I think people are still mad about it. I think a lot of the polarization that we have today stems from the perception on Main Street that not only did we bail these guys out, but we bailed them out very generously.
I couldn't agree more. Let me shock listeners by saying I think President Trump got something right, almost accidentally, by taking a piece of a company like Intel. My big complaint during the bailouts were, hey, if you're going to give these publicly traded companies a bailout and not send them to bankruptcy court, well, great. Take 40% of the company and promise to sell it back to the public markets within a decade.
Right.
And it would have cut the cost of bailouts substantially and would have hurt existing shareholders and management who made who helped create the whole disaster.
That's exactly right. Yeah, no, I think that was we did a little bit of that, but not enough, because I think there was just a visceral reaction against being too tough. So
when the alternative is that handsome building downtown with the tall columns and the judge who basically says, okay, you're now in receivership. When you look at the next best alternative is you're toast. Okay, we'll give up 40% at a substantial discount and live to fight another day.
I couldn't agree more. They were looking. Their baseline was what how these companies had operated before they got into trouble, and my baseline was bankruptcy was the alternative. We did, but it was uneven too. So we put Fannie and Freddie into conservatorship.
Right.
And maybe they should have been put in bankruptcy too, but they were the statute provided for conservatorship, where they still languished. So they got punished pretty well, and they didn't. We were still getting. Now they're allowed to keep their capital to build their capital base, but the government's made quite a bit of money since then from that. AIG, poor AIG, they were they were effectively put in conservatorship by the Fed. And finally emerged from that. But, there was an unevenness, too, with the way that some of those entities were treated versus, for instance, a Citigroup, which, what else can we do to help you, Citigroup?
For the third time, fourth time?
Four times,
They're like every generation. Yeah. They're back with their hat in hands.
And they will be again.
We need a few
Fraser.
Billion, right?
I'm rooting for, but historically, Citi's going to be back.
so I'm kind of fascinated by, over the course of your career, you have spanned 3 distinct cycles of deregulation.
Right.
So we had Gramm-Leach-Bliley, which certainly was a major factor that led to the GFC.
Yes, it was.
We have the entire Dodd-Frank deregulation of the decade, the past decade, and then everything that's like all the carve-outs, and then most recently reducing the amount of net cap in reserve that banks have to hold.
That's ongoing.
So why do we keep having these crises? Is it structural? Is it the American political system? It seems like we're constantly repeating these cycles over and over.
Yeah. Well, we are, and deregulation was a big part of the crisis. Nobody wants to say that, or just lack of regulation. The Fed, and Bernanke and Greenspan have both said this, the Fed had the authority to write lending standards, mortgage lending standards for the entire industry. Problem is, most of these mortgages are being originated by non-banks. The banks were funding it, but they were providing the conduit funding to get them into securitizations. But the Fed had the power to stop that and just flat out refuse, we don't want to constrain credit. If I hear that once, I think those are, Warren Buffett once said the most dangerous words in finance, or everybody else is doing it. I think we're going to expand access to credit. I swear to God, because it is used as an excuse for so many terrible lending decisions.
Didn't Greenspan say, we don't want to stifle innovation in the finance markets?
Those are the interest words, too.
Right?
I don't want to stifle innovation either, but it's just used as an excuse. Like we got to reduce capital to get more lending out there. When I would argue there's too much lending out there already. We're seeing all the cockroaches scurrying out now. So it was in derivatives, as you said. Gramm-Leach-Bliley broke down created these too big to fail institutions that all got bailed out. But also derivatives, their basically decision was that nobody needs to regulate derivatives markets. The theory was, the big banks were dealers, the derivatives dealers, they're regulated by the bank regulators, so we don't need market regulation. And that did not turn out so well, because the thing about the mortgage crisis was there were hundreds of billions of mortgages going bad, but there were trillions and trillions of financial engineering on top of how those mortgages would perform. And that's really what got us at the end of the day. There were a lot of mortgages that never should have been made, but the system could have absorbed those underlying losses. It was the derivatives on top of that really brought things down suddenly.
So let's talk a little bit about finance. The world has really gotten kind of interesting in terms of we still seem to be dealing with the echoes of the financial crisis. It's amazing. It's almost 20 years ago, and yet things like when SVB, Silicon Valley Bank, and Signature Bank failed in 2003, people started to get concerned about systemic risk, even though these are kind of two
Yeah,
minor,
those are not systemic. It was
right?
never a reaction. Yeah.
Systemically important
They were not.
financial
Yeah.
institutions. And yet, in order to cover uninsured depositors,
Yeah.
um,
Who are
regulators.
the richest people? So among the richest people in the country.
Gee, I wonder
Yeah.
I wonder if that's just a total coincidence, or if some upset
Yeah,
people made some
you
phone
think.
calls.
Yeah, I was appalled.
Because if your local credit union
Yeah.
goes out
Yeah.
and you're
you're taking a loss if you're an uninsured depositor or
Yeah.
a community bank. Yeah, you bet.
but
Yeah.
if you're a Silicon Valley VC and you're
Yeah,
connected,
yeah.
you get
Stablecoin issuer, yeah. It's like
So-
that was so funny. The Biden administration was doing everything they could to kill crypto on one hand, and then they bail out one of the biggest stablecoin issuers, who had $2.5 billion or so of uninsured deposits. You're really irresponsible on their part to put that much of their reserves in uninsured deposits, but they were bailed out. I couldn't believe it. I wrote a very strong piece in the Financial Times after it happened. It was just this knee-jerk bailout, especially if they're rich, powerful people. I was appalled. I'm still appalled. It was $200 billion. It was not systemic. It had good assets. If they should have tried to find a buyer quickly.
like Washington Mutual.
Yeah. So, but there was, I think, nobody said this, but my suspicion is there is kind of this Biden administration religious aversity to bank mergers and acquisitions. Like, we can't make banks bigger. So instead of quickly trying to market and sell it, they didn't do that. And but even if they hadn't, if they just put it into a bridge bank, they had good assets. They probably could have paid 85, 90 cents on the dollar to be uninsured.
Didn't someone else come along and buy all the assets anyway?
Yeah.
So the merger
it
happened regardless.
But it cost the FDIC was $17-18 billion, the deposit insurance fund. It was outrageous. I'm still aghast that even happened. It annoys me with my Democrat friends who pretend that the Republicans are the ones that are pro-industry and pro-bailout, and then they do something like that. So go figure.
So let's talk about something else that's a potential issue. Private credit has exploded in the past decade. It's now over $2 trillion. And while we have all of these private non-bank credit funds, they're all being funded by regulated banks.
Yeah.
Is this just regulatory arbitrage?
Well, it is but not in the way that I think the banks' sound bites make it sound. So their sound bite is that the capital regulations are too onerous, much tougher than they are for these private funds, which is nonsense. The private funds are much less levered than banks. Right? Banks are on a non-risk weighted basis. These big banks are operating with 6-8% capital funding,
right.
That's equity funding. So it's not like they have tougher capital requirements. The problem is these risk-based rules, and this is exactly what was going on in subprime too. The risk-based rules, through the magic of securitization structures and quote-unquote over-collateralization, you can lend to a private fund, and the private fund will give you collateral. They'll give you their loans, and they'll say they'll be valued at 150% of what your loan is, right? So that you're way over-collateralized. And if you do it that way, the capital rules will give you a very favorable capital treatment. So you can use a lot of leverage, increasing your return on equity with that by lending to the fund. If you make the loan directly to the highly levered business who the fund is lending to, you've got a very, very high capital charge. Mm-hmm. And so the argument is, well, you're directly exposed to this highly levered business, so you need to have it tougher than if you just lend to the fund. The problem is that you're basically allowing banks to lend and fund indirectly highly risky mortgages that they would not do or not be permitted to do, frankly, if they were doing it directly. And that's exactly what was going on with subprime. These horrible, unaffordable mortgages peddled to a lot of people who didn't understand what they were getting. The banks were funding that through their credit lines and their warehouse funding to, provide the money to the originators, packaging them up with securitization and selling them. And again, the capital required for that was much, much less than actually making a mortgage yourself and holding it. So it really is the same basic flaw in how the risk-based capital rules work. I would just say you can't fund a loan directly or indirectly that doesn't meet prudent underwriting standards, because what happens is the banks, from a societal standpoint, the banks are funding a lot of really risky loans that, if they go bad, can have broader bad adverse ramifications for the economy. But they don't look at it that way. And in point of fact, there are pending capital rules now that will make it even more favorable for these banks to be lending to these intermediary funds as opposed to lending directly. So that's what's driving this, not because banks have much tougher capital rules than private funds. That is not true. It's just that if they can use more leverage to lend to the fund directly than to lend to the business itself.
Here's what the banks say, and I don't necessarily believe this, but it's not completely unconscionable. They say when we were securitizing loans during the financial crisis, lending standards had been completely abdicated in all of these no income check, no job check, just
that's true.
Sign and pray, and then it'll all come out in the collateralization and the syndication. We'll spread the risk around.
Right.
This is, hey, we're lending money to firms that have been in operation for 10, 20 years, and names like Apollo and Carlyle and Blackstone, who are trying to get a return on investment. And this sounds a little familiar. They would never put their reputations or their names at risk by doing anything too stupid. And besides, the default rates have been really low, and it's highly spread out across sectors and geographies.
Yeah.
Is that a fair argument, or
it is a fair argument? And I'm not saying private credit is a legitimate asset class. I don't think it's systemic, primarily because you don't have all this financial engineering sitting on top of it. I do think they've been making some really risky loans. There are a lot of conflicts of interest involved, since a lot of the private credit funds are affiliated with the private equity funds. They're lending to the private equity portfolio companies. And this is a particular problem. Actually, I think this is an investor protection issue more than systemic issue. I really do. And for sophisticated investors, I think private credit is absolutely a legitimate asset class. Got to understand it's not regulated. You don't really know what the loans are worth, right? So there's a big problem with getting a proper valuation on the assets. Not a lot of transparency for retail or even high net worth individuals. There's a liquidity issue, right? The business model doesn't really work unless most of the capital is locked in. And frankly, there's a lot of research questioning whether it really provides better returns. The S&P 500 has been kicking it for several years now. So, so there are a lot of questions. But for sophisticated investors, go forth and do it. And I don't think it's systemic, but I do. And I do worry about these life insurance companies and the annuitants, because again, you've got a private equity-owned life insurance affiliate. You've got the private credit affiliate. You've got the life insurance affiliate lending into the private credit affiliate. You're using these third-party credit raters to make sure, it's all at arm's length. But,
very incestuous.
And the BIS did a study about a year ago on this, and others have taken a look at these valuations, and they're finding significant evidence of inflated values. So I do think we need to protect at the retail level. There need to be some not expanding access to this.
So you're not a
asset
fan
class.
of private equity or private debt in 401ks?
No, I am not. As a matter of fact, I am not. You know what? If you want to, there's a you want to buy a stock in KKR, go for it. You might check how it's been performing. And actually, I don't know how it's been performing. But I'm just saying, if you really want exposure, there are publicly traded ways. BDCs now. There are publicly traded BDCs. There are public ways to do it. There are some funds, 40 Act funds, that do invest a small percentage in alternatives too. So there are ways now. But yeah, opening it up directly for retail, especially 401ks, to start loading up on this asset class, I think is really problematic. And I do worry that the plan sponsors, the fund sponsors, the 401k sponsors are going to be getting the hard sell about putting this stuff into people's 401ks. And I don't think retail. I know I don't. I don't want exposure to it. I've read enough to make me really worried about it. So I think really sophisticated big institutions, which have traditionally been their investor base, they want to do it fine. But no, it's not right for retail, and it shouldn't be going into 401ks. And I'm very worried about that.
And to put some numbers on what you had referenced about the performance, the median alternative funds doesn't do all that great.
No, it
It's
doesn't.
not that diversified,
No.
and it doesn't outperform the S&P 500. Hey, if you're lucky enough to get into a top decile fund,
Exactly.
you're going to kill it, but it's going to take
How
a
many
couple of $100
401k
million
Yes, exactly.
to have access to
yeah,
that. That's,
The retail people are not going to be getting the creme de la creme on this. No, that's a huge issue. They're going to stuff the riskier stuff into the 401ks. So,
it makes a lot of sense. So we've talked about everything but too big to fail,
Right.
which was a big part of the lead up to the financial crisis, and how the Fed, the FDIC, everybody dealt with it afterwards. As an example, J.P. Morgan Chase now has over $4 trillion with a T
Yeah.
in assets. Can a bank that size be effectively regulated? Is too big to fail the norm now?
Oh, I think so. It absolutely is. I mean, I worked hard in Dodd-Frank to come up with, to instill better authorities to put these large institutions into a resolution type process where you would impose that accountability. You could fire the top management, the boards, make the shareholders and bondholders, unsecured creditors, absorb the losses, all the stuff we didn't do during the crisis.
You mean normal bankruptcy rules?
Yeah, exactly. Yeah, well, it was similar to the FDIC process, which is basically a bankruptcy process. And in Title II and Dodd-Frank provides for both the Title II mechanism, which is FDIC run, and a bankruptcy process, a Title I process. So the tools are there, but I don't think there's any. I hate to say this, but I don't think there's any chance they'd ever use it. I really don't. I think they're going to bail out again. They already do. They'll set up special lending facilities or ratchet interest rates down. They'll if private equity. So actually, I worry more about private equity than private credit, because private equity funds are heavily exposed to software companies, which we don't know how that's going to shake out. But there's quite a bit of concentration there. So, but if that sector gets into trouble, the Fed will lend to the banks, who can then lend to the funds. I mean, that's just the way I think it works now. And I think a lot of the push for ever more deregulation, lower capital rules, is based on the assumption of the big bank lobbyist that they're never going to go down. There's another kerfuffle, another problem. The Fed's just going to open up the spigot again. So, why should they have to operate with all this capital when they can lower their capital and get much higher returns on equity? And I do think that's the unspoken rationale, because it doesn't make any sense otherwise, because we've got a lot of uncertainties in the banking system right now. To be lowering capital makes no sense unless you're just banking on a bailout if things get dicey.
Let's talk about a financial crisis that really has gotten a lot of short shrift given everything else we just discussed, which is the student debt crisis.
Yeah.
We've seen just an explosion of student loans. It was briefly, and defaults. It was briefly put on pause during the pandemic and right afterwards. I just saw a survey earlier today that said 83% of young people say this is a bad economy, when by most historical measures, it's a booming economy.
Yeah.
So how did we get here? Why is it so difficult to fix? What is a potential policy solution to the student debt crisis?
Yeah. Well, and I think the headline numbers are, in this K-shaped economy, I think the headline numbers can be misleading, because you got to look at how all that wealth is being distributed. But I think for student debt, I will give credit to the Trump administration in Congress, the BBB, the Big Beautiful Bill. I hate that name, but it had some really important reforms to the student loan system. So they've dramatically simplified the repayment options. There's now a standard plan and one income-based repayment plan. They have imposed some accountability on colleges, which desperately needed to be done. And so it's easier to kick colleges now with high default rates out of the loan system. They have gotten rid of negative amortizations. One of the frustrating things about student loan borrowers was that, because in previous administrations, the repayment plans that were based on a percentage of your income were set so low that people some of them were paying zero. Because you had to earn a certain amount of money before a loan payment obligation even kicked in. But what happened was, then they were, for bookkeeping purposes or whatever, they would negatively amortize the loan. So all your unpaid interest was going into your debt principal, and it was getting bigger and bigger.
Just
So
recapitalized
So
forever.
even if you were making some payment, you got frustrated because your debt was getting bigger and bigger. That's all gone away with now. Negative amortization has been abolished. Everybody has to pay at least $10 a month. I don't think that's unreasonable. If you got a loan from taxpayers, even if you're struggling, you can pay $10 a month. And then so if that payment is so low, if your income-driven payment is so low that you're not covering your interest, the government will pay $50 a month to lower your principal. So long as you're making at least $10 a month, your principal will go down each month. And I think it's simpler and will provide better incentives to make loan payments, keep up the loan payments, because you'll actually be able to see the principal going down. So I give credit, and in full disclosure, my son, who's a fellow at the AEI, was also heavily involved in this. So he's a chip off the old block, though. We think alike when it comes to student debt. Yeah, simplification, more accountability. And those are the things that this bill accomplished. So I'm hoping that this gets straightened up, and people are having to pay now. But the transition to going from not paying for years, and Trump did that too. We had this 3 or 4 year long moratorium. People are going to have to pay now. It's going to hurt. They haven't made room in their budget for these loan payments.
Well, $10 a month isn't
It's not huge, no. It's
right.
not,
And
yeah.
if the government is kicking in 50,
Yeah.
I mean, it's not a ton of money, but
No,
it's still
it's not.
$600 a
Yeah,
year.
yeah.
Have we done enough to resolve the student debt crisis, or
No.
what else can we do to move this along?
Yeah, well, I do think there needs to be more accountability for colleges to assume some
The
of the
schools
losses.
themselves.
Yes, the colleges themselves, because it was the classic misaligned economic incentives. So, with the best of intentions, the Congress said, okay, and from now on, all the student loans are going to be made. Pretty much all of them are going to be made by the government, because we're worried that banks are not treating borrowers as well as they should. So we're going to be doing this, and then the colleges themselves will basically originate the loans. So you apply to a college, and the college financial aid office will come up with a financial aid package, and they will calculate how much you need to borrow to go to their school. Well, now, what are their incentives? They're going to get the money. Right?
Right.
You're buying for tuition, room, and board. So they're going to get the money. They're not on the hook if the student can't repay the loan. So what do you think is going to happen? And what happened exactly is you could have predicted it. Inflation, with tuition, many multiples.
9% a year for 40 years, 50 years.
For whatever, yeah.
it's
So
crazy.
tuition, as any parent knows or student knows, is skyrocketed, become very unaffordable without borrowing. And but there was all this easy money, and the undergraduate is a problem. But the graduate schools, a lot of young people then sold a bill of goods to get a master's or a PhD, because they're unlike undergraduate loans. There is some caps on your federal loans, but no effective caps. That's been changed now too. There are some caps, thank goodness, on your graduate and professional schools. So somebody like me, I'm going to go get a PhD in philosophy so I can teach, right? So I paid $300,000 to get my PhD in philosophy and get a job, maybe paying $60,000 a year at some small college. Well, that makes sense, but I think that's happened to a lot of people, and I don't think, I don't absolve the borrower either. They should have known better. But the schools let this happen. These graduate professional schools can be real moneymakers. They are. The graduate schools in particular are real moneymakers for colleges, and the degrees are frequently do not enhance the earnings potential of the student.
So do you have any hope that students are in a better shape financially going forward, or is this still very problematic and needs more help?
I think things are getting better, and a lot of it is something else that the first Trump administration did, which Biden continues, and the current Trump administration continues, is to publish postgraduate outcomes. So you can go on College Scoreboard now and put in a college and a degree that you may be thinking about it, and you can see what the graduates are actually making, and you can find out the graduation rate, you can find out the retention rate, you can find out all sorts of information that will tell you, is that college graduating students, and are they getting good jobs after they leave? And so I think more and more parents and student advisors, high school, college advisors are using those tools. There are more calculators too that are based on help you figure out how much you can borrow based on what your postgraduate income will likely be in that field at that college. So there is more awareness. And then I think a lot of, ironically, this is coming back to bite a lot of the colleges now, because I think it got so expensive. People are starting to take a second look. Well, do I really need to go to college? For so long there was all this social pressure to go to college. I was a college president. I've taught a university. I think it's a wonderful experience, but it's not for everybody, and you don't have to do it, and there's no stigma if you don't do it. You might want to go directly into the workforce, learn on the job. You might want to go to a trade school. There are, community colleges. You got to be careful there too, but many of them provide really good, education that's less expensive and a shorter duration. So I think students and their parents are also thinking more broadly that they don't have to go to college. There may be other options available.
Last question about college and education. We have thousands and thousands of universities and colleges. Do we have too many?
Too many? Yeah, probably.
I mean,
do.
are we going to lose 10 or 20% of the college base over the next decade?
We probably will, and I think the part of it that's really struggling now are the private liberal arts schools. And they became too pricey. And I think that's sad, because I used to be the president of one of those colleges. And I think they do offer a very special educational experience. A very, it's more high touch. It's more, for some, going to college when you're 17, 18 years old can be pretty traumatic. You've never been away from home, And so for some students, that small, intimate college environment was a good option, but they're really struggling now. And so I think we'll still have them, but I think there'll be a lot of consolidation there. And then it's the weaker schools. If they're not proving their worth, they're gonna close probably.
Huh.
Yeah.
Really, really fascinating. So you went from writing a crisis memoir for adults to totally the opposite direction, basic financial literacy for children. What made you decide to aim in between at young adults and teenagers?
Yeah. Well, actually, it was my editor who, everybody, when I first started running the picture books, everybody said, oh, this is too, elementary school children are too young for this. And they're not. They absolutely, and the books have sold well, and they totally get it. But my publisher, everybody said you need to write a book for teenagers, and my publisher thought that was a good idea as well. And so I thought about it, and I thought, yeah, because, there's more and more financial education being required in high schools, and I'm concerned that as schools start offering these courses, that there's, good quality, accurate content. There's a lot of people out there providing financial, a lot of people on social media, a lot of curricula, sponsored by industry groups. And so I thought, well, I'm gonna throw my hat in here to try to provide just some basic financial advice to teenagers as they're entering adulthood. So that was I will have to say my publisher's initiative, but I think it was a good idea, and I'm pleased with the way the book came out.
So I'm glad you brought up social media.
Yeah.
Gen Z and what's the new generation after them? Generation Alpha.
Yeah, I can't
someone
keep track
said
of it
Generation
either.
Jones is another one. I can't keep up with it, but they all seem to get a lot of financial advice from Instagram and YouTube and TikTok rather than, let's say, more professional, experienced folks.
Right.
How did that impact how you thought about reaching this age group, and how did it shape the tone of your book?
Yeah, so it was, I did want to get some accurate information out there, because there's a big theme of this book is, I say in the introduction, building wealth is not hard. You need to establish a regular saving and investing habit. You need to avoid debt. That's really what you need to do. But there's so much advice that's just the opposite, and especially on social media, it pushes debt, Well, why bother with a nice safe index fund? You can go borrow some money and buy a rental property and make way more returns. No. So, but there's crazy stuff like that, or borrowing to invest in crypto or meme stocks, or gambling. And their kids are getting confused about the difference between gambling and investing. They're very different things. So I wanted to provide some correctives to that, and then just basically also address and flag common financial behaviors that cost people money, like carrying a credit card balance. That I'm very open in my first chapter about I totally got in trouble with credit card debt. I was just graduated from law school. I was a civil rights lawyer then, didn't know anything about finance, didn't care, thought it was beneath me. I needed to, buy some clothes for work. I needed to get an apartment and furnish my apartment. And as I was getting all these solicitations from various credit card issuers who had found out that I was now, working for a living somehow. So, yeah, I got in trouble with credit card debt, and I made that minimum payment. I thought, wow, this is great. I can borrow this money and just this tiny little payment every month. And I ended up, I think it was about $6,000 in interest when all was said and
Oh,
done.
my God. That's a lot.
Well, yeah, which if it invests in the S&P 500 would be worth around $250,000 now. So there you go. So, but I think just avoiding things like that. The average family pays $1,600 a year in credit card interest. If that was just put into an S&P 500 index fund, boy, over 30 or 40 years, you're talking real money. Huh. So that was I wanted to emphasize that is the simplicity of how to build wealth. Compounding, opportunity cost are big themes. I think those are so fundamental to understanding how to manage money. And but I just want to help kids avoid mistakes. I don't want them to have financial problems when they grow up. I want them to get off on the right foot, which I did not, and a lot of people don't.
So you mentioned a couple of really interesting things that taken together, Howard Lindzen runs a venture fund, and he calls it the degenerate economy: gambling, speculation, end-of-day options, meme stocks, crypto coins.
Yeah.
And all of these have been through apps and other methods, because of the phones, have been adopted by teenagers en masse. What do you make of the degen economy, and what does it mean to the future health of these young adults?
Well, it's very dangerous, and it's particularly a problem with young boys. And, oh, by the way, they shouldn't be doing this if they're under 18, but a lot of them are, as we know. They're targeted, and they don't understand the worth of money. The apps just make it so easy. They don't make the connection between the financial losses they're experiencing. It's a game for them, and the industry advertises they do gamify it. So, and even, stock trading, some of these online brokers, the big ones, they gamify it. And it's not a game. It's serious. Money's serious. And I think one of the things from early on, if parents give their children allowances but tie that to work, I think it's really important for kids to understand early on the connection between work and money. It's not just free, easy, because too many kids don't make that connection, and their parents are generous with the credit cards or whatever. And they use their credit card numbers to do all these gaming apps, and I just don't think the reality of what these kids are doing actually sinks in until they're really in over their head. And I think it's purposeful. I think, kids don't understand the difference between gambling and investing. Well, there's a big difference. You're investing, you're supporting capital formation in the real economy, helping businesses who make real goods and real services raise money and operate, or supporting the secondary market that enables all of that. And what are you supporting with gambling or crypto? I mean, some crypto, to the extent it represents the technology, I think crypto technology is very valuable. But these different currencies and tokens, they have nothing behind them.
You can call them shit coins.
Okay,
That's what they are.
I'll call them shit coins because there's nothing behind them. I'm amazed that Bitcoin is held up. I think it's just, it's kind of the granddaddy of them all. So if you're going to invest, most people do a Bitcoin because they've heard about it, and the rest of it is crap. Bitcoin may be too, but it has lasted. I will give it that. But what are they supporting? And they're losing money. There was a study done of gambling apps that showed that the people that use gambling apps, only 5% take out more money than they put in. And it's addictive. And these gambling platforms, even if you start winning, well, wow, oh, you're doing great. Here's a little money. Why don't you keep going? They want you to keep going until you start losing money, because the odds are you will always lose money. And Bloomberg came out with some great research recently on prediction markets. 75% of the profits, I believe, are going to 1% of the
Less
users.
Than 1%.
Less
than
1%.
It's crazy.
So
it's so
money. The whole game is rigged. Well, even active trading of stocks, very few people can do that and make money
consistently over time.
Yeah, and you're going to be going against people who do it for a living. They have a lot more access to data and expertise, and algorithms and all the things, all the tools you will not have when you try to actively trade stocks.
So this is kind of fascinating. I bet most people don't know how much of a passion project this has been for you so long. Did I read this correctly? You established the Financial Education Division within the Treasury Department.
I did. The Office
early
of Financial
2000s?
Education. In 2001, Yeah, well, I did. I established the Office of Financial Education, and it's grown now. It's in the Treasurer's office now, and I think they hold a group It's called FLEC, and it's basically a council of all the different financial education components of the various different regulatory agencies. And it's a good group. Yeah, I did start it. That's one of the things that got me interested. And actually, my first book was pre-crisis. Rock and the Savings Shock. It actually came out in 2006, because based on that experience, it inspired me to start writing kids' books, because I became aware that there really weren't any resources for elementary age schools.
So How Not to Lose $1 Million covers basics like savings accounts,
Right.
student loans, debt
Right.
avoidance,
Right.
and retirement planning.
Yep.
It kind of raises a question: why aren't we teaching our kids financial fundamentals at the grade school level?
Yeah.
Why is this not just part of civics and
Yeah. Well, it can and should be. I mean, I think there's a big movement now to have a standalone high school personal finance class, which I think is good. But it needs to be more than that. It needs to be every year. It needs to be introduced. And, math curricula is an obvious place, because I think it will make math more interesting to kids if you do use money examples, right? So you want to learn about ratios and percentages. Let's talk about compounding and how much your money grows at 4% interest a year or whatever. So it does need to be introduced every year, and again, that's one of the reasons my books are. I mean, they're supplements to curricula. I don't write educational curricula, but there certainly could be assigned readings to go with those classroom efforts, and I think that's important. And the kids get it; they're interested in it. They absolutely get it. They're not too young.
One of my favorite parts of the BBB was the newborn accounts.
Oh, the Trump accounts,
the
yeah.
baby bonds,
Yeah.
which Cory Booker started talking about. I'm drawing a blank on the name of the venture capitalist who suggested something like this years ago. But it's only $1,000 to every newborn in an investment account.
Yeah.
Is this a good start? Is this going to help kids learn about money?
Yeah, it absolutely is. I think, it's only for, there's a 3-year period where if children are born within this 3-year period, we'll get the $1,000. But it can be matched by employers. A lot of employers have.
We're hearing already
it.
Dell and
Yeah.
J.P. Morgan and a bunch of big employers announced they'll do a $1,000 match.
Exactly. Yeah.
And the assumption is this will be renewed after 3 years.
I hope so. I hope it is. I'm kind of a fiscal conservative when it comes to our deficits, but I think this is a good way to spend the money. Because it goes directly, you know where it's going, you know it's helping, and it's a wonderful way to learn about the power of compounding. Congress mandated the money has to be invested in broad-based index funds, which is good. Or we'd be seeing crypto and meme stocks or whatever.
Right.
So that's good, but you can see over time how it will grow, and I hope. When they're 18, they can take it out, but I hope they leave it there, and it just converts into a regular IRA at that point. But it's great. It's a wonderful financial educational tool, as well as some additional financial security for low-income families and their children.
So let's talk about another aspect of money that's so different today than it was when we were kids. Money is effectively invisible. Credit cards, apps, buy now, pay later, subscriptions, all that. There have been studies that have shown that if you give people a pile of cash to spend or a credit card loaded with the same amount, they spend more with the credit card than with actually paying, greenbacks, which says a lot about the psychology of, modern spending.
It does.
So how do we recognize that, and how do we teach kids the value of $1? It's really a challenge when you just tap the card and it's magic.
It's not real money. It's funny money. Yeah. Well, that's what I think it's important to attach an allowance to jobs. I think helping kids make the connection between having to work and earning money is really, really important, because the parents are too generous. They let them use their credit card, so they start getting that easy usage. And if they're using their parents' credit card, they're not it's not causing them any pain to spend money. So I think the parents can control a lot of this, but the kids need to understand the connection between earning money and spending money. And if they make that connection, they will be more judicious and careful with their money, because they realize how dear it is, because that $10 took an hour of their life raking leaves or whatever, So I think it's important to make that connection. And financial education, understanding, I have a chapter I spend a lot of time on credit cards, because I think it is an early trap for a lot of families and a lot of kids. because it's just so easy. And BNPL is the same thing. BNPL, I don't like it.
Buy now, pay later.
Buy now, pay later. The whole idea is to facilitate impulse buying. Let's face it, you're using BNPL when it's really beyond your budget to buy. You weren't thinking about buy it. You don't really have the money now to buy it, but you really want it. And that's what BNPL does. And they're, BNPL users, a very high percentage of them, first of all, it's not interest free because it ends up going on your credit card because you can't pay it off. So you're just carrying the balance on your credit card. Or it's coming out of your checking account and you overdraft and you get an overdraft fee. So it's not really, they say it's interest free. For a lot of users, it's not really. It gets them into financial trouble.
When we were kids, it was called layaway.
That's right.
And you didn't get the good or item until you paid it off. And you very much understood, I got to shovel more sidewalks or mow more lawns if I want that bike or whatever it happened to be.
Exactly. Yeah.
This is the opposite lesson.
It is. It totally is. And so I think it feeds a lot of overspending. I think impulse, kids are making decisions more impulsively. I mean, they don't have the same impulse control adults have. And I think, people know that, retailers know that, commercial entities know that. So they try to encourage them to make snap decisions to buy something. And it's so important. I have a rule, wait a week, in my chapter on budgeting about buying things. Just wait a week. There's some things you have to buy, your needs, like your rent or whatever. Right. But if it's your wants, first of all, don't buy any want that's not within your budget. And even if you do, wait a week. Just don't buy it on impulse. Wait a week, come back to it. Do you really want to or not? When I go into grade schools and do readings, my common question is, raise your hand if you've ever bought something you wish you hadn't bought.
Every hand goes up.
Yeah. Every hand goes up. It's amazing. Yeah. Already, at 7 years old, they've got buyer's remorse. It's usually junky toys.
Speaking of junky toys, when there's a car I fixate on, my little hack is I'll buy one of the die-cast models and put it on my shelf. So for $60, I have a little experience in this car. Yeah. And after a few weeks, it's like, all right, I have the toy. I'm good. I don't need to spend $100,000 on another stupid thing for the garage.
Well, that's right. There's a chapter on buying a car too. I just bought a car, actually, a used car. I didn't want to. They depreciate so fast. This is going to be a second car, but this I couldn't believe it. I mean, I knew this. I've had experience in the past. It's been a while since I bought a car. He was trying to upsell me with everything, and now they're trying to give me all these service contracts that would increase the price of the car by about 25%. It's just unbelievable. Kids want to buy cars. They want their own car.
I don't think that's true anymore.
Maybe not.
A lot of kids aren't getting licenses. They can Uber wherever on mom's
in urban
credit
areas,
card.
I think that's true.
Right? Yeah. And although there is a renaissance of kids buying, let's call them 20-year-old analog as opposed to digital cars with stick shifts.
Really?
Like there's a whole generation of new car enthusiasts coming up that I think a stick shift today is an anti-theft device because you bring it to a valet, they look at you, go to a restaurant, they're like, would you mind pulling it in over there? Yeah, okay.
That's funny.
But it's really true.
It's good because, cars are expensive. The average monthly payment is like $700 a month, for a young boy.
It's $1,000 a month is not uncommon on a lease.
Yeah.
And kids don't understand why. Hey, no down payment.
Yeah.
Well, but no residual. At the end, you hand it back.
That's right.
It's just the cost.
That's exactly right. Yeah. So it's really expensive for a young person to buy a car if they can avoid that.
So I only have you for a few more minutes. Yeah. So let me jump to my favorite questions I ask all my guests, starting with, tell us about your mentors who helped shape this career you've enjoyed through academia, finance, and government.
Yeah. Well, Bob Dole obviously stands out. He was really, he really taught me what public service meant, and he was always focused on the public interest. He was a populist in the good sense. He was from a small rural town in Kansas. He was horribly injured during World War II, laid up for years. The townspeople rallied, supported him, got him back to health, helped him become who he became. So he really focused on the public, and I learned that, and I think later in my career and at the FDIC, we kept that focus on the public, the people who are using the banks, not the banks. Who are we helping? We're helping the people who use banks. So I I'm proud of that, and I learned a lot from him. You know, later I got to know Paul Volcker. I learned a lot from him.
Paul.
Yeah, that's right. Um, Elizabeth Dole was someone I never really had a chance to work with her, but I knew her through the Senator Bob, and have maintained contact with her over years. Another woman who inspired me, not a mentor, but Sandra Day O'Connor, the first woman Supreme Court justice. When I was on the Judiciary Committee, I got to handle her confirmation, and she was just a lovely person. So, a lot of people I've met over the years, but Dole really stands out as my prime supporter and mentor in my career. Yeah.
Let's talk about books. What are you reading now? What are some of your favorites?
Yeah, so I love murder mysteries. I'm reading Anthony Horowitz's new book, A Deadly Episode. I don't know if you know Anthony Horowitz. He's a British mystery
I know
writer.
the name.
Yeah.
My wife is a fan of those, so she
She would
burns
know
through
him.
those.
Yeah, he's quite prolific. Yeah,
Right.
he was he was actually chosen by the Ian Fleming estate to continue writing
Oh, no
Bond. But he's
kidding.
written two. They're really good. Yeah, I actually like them
now
better than Ian Fleming.
owned by Amazon,
Yeah,
the movie
that's
franchise.
right. That's right. So, and then I'm reading John Hersey's Hiroshima. My family and I are going to Japan at the end of the month, and I
I'm
wanted to
dying to
take
go.
them. Yeah, and the kids kind of balked. I said we're going to go to Hiroshima because I think that's an important part of history. We need to see this and understand it. And I read Hiroshima when I was young, probably high school, I think,
Right.
when it came out. And it had such an impact on me, and so I'm reading it again, and it still has an impact on me, and especially everything going on in the world now, and other countries, even Japan, talking about wanting to have a nuclear capability because things just don't seem very unsettled on that score right now. So those are my two. I usually have two books going, one nonfiction and one fiction. So
I'm going to recommend a book to you. It's
Okay.
just really kind of fascinating. An American who's a professor somewhere in the UK, Brian Klaas with two A's, and the book is called Fluke. And the book starts with the story of a young couple honeymooning in Kyoto. Later in life, the husband becomes the head of the War Department. And when we have to figure out where to drop the A-bomb, he absolutely vetoes Kyoto. And Hiroshima is what gets
chosen.
because this couple went there for a honeymoon.
Oh,
that
that's really interesting.
country, that city is spared. And then it wasn't supposed to be Nagasaki. It was I don't remember what city it was, but there was cloud cover and they couldn't, back then you were doing visual reads.
Right.
You couldn't see, so they went to the secondary target.
Yeah.
And so talk about flukes,
Yeah.
how random
Really?
things are.
Yeah.
So Hiroshima gets it because somebody went there on a
On a honeymoon.
Just crazy.
Well, and now you look back, and why did any city get it? Couldn't you drop it over the ocean or something? You want to make a point. I mean, really, I don't. It's hard for me to understand now. I know, and that's just, we're not there at the time. There was a lot of
the psychology during wartime.
yeah,
So different.
And the Japanese everybody had been horrible, but the Japanese had done some brutal things.
Well, for
And-
centuries.
Yeah, well, yeah, okay, all right.
Speak to
But-
China and
Trouble,
Korea.
going
They
to
are not.
Japan. No.
I'm a big fan of Japan.
Yeah.
But
no,
they were
yeah.
quite
Oh,
a
they were in
ruthless
China?
empire
oh my
for
God.
a long
yeah,
time.
Yeah, so there was a lot of. So I understand that, and I think, well, maybe the horror of it, when and I think that's why John Hersey's book was so important, because it really underscored the horror of it. But maybe because people then understood how horrible it was, it made it even less likely anybody would ever use it again. I'm going to rationalize it that way, but it is hard. You look back and, oh my gosh, did we really have to do that to people? Because it was not just the people who probably were killed immediately were the lucky ones.
Oh, yeah.
The radiation sickness after the horrors.
I
and the
think I
slow
got
death
assigned
was-
that same book in high school. And,
Everybody read it,
and
yeah.
plowed through it, and it was just.
It was, yeah. No, it's very well
horrifying.
written. It was, yeah.
Let's shift to. Are you streaming anything these days? You listen to any podcasts
don't
or watching anything?
Yeah. I don't stream or podcast that much. I get I like to read transcripts of podcasts because I can read
You
a lot
read it much
faster than I can
faster.
listen. Yeah.
How about Netflix or HBO?
Yeah,
or anything
you know,
like that?
again, I'm, one note on this: BBC. I'm there. I love the
BritBox?
murder
Do
mystery.
you watch
BritBox, yeah. The all the Agatha Christie's I've seen. The David Suchet prose are by far
Mm-hmm.
the best. Foyle's War was great. Also, Anthony Horowitz. He did
They made it into a series or a movie.
Which one? The Foils
Foils
of
of
War.
War.
Oh, Foils of War. Actually, that was a TV series. It wasn't a book. That was one of the few things, but it's really good. I like the Morse. Have you ever watched Morse? Inspector Morse? No,
That sounds
a
vaguely
famous.
familiar.
Yeah,
That used to
there's
be
a
on
whole.
PBS at one point.
Yeah, it's old, but
Yeah.
there were three: Morse, and then Endeavor, which was about Morse when he was younger, and then Lewis, who was Morse's sidekick. So BBC did a really good job there. So yeah, these are old stuff. I recycle them. But yeah, I love BBC and I love BritBox. Excuse me. I love
Our
British
final
murder
two
mysteries.
questions. What sort of advice would you give to a recent college grad interested in a career in banking or finance or government service?
Yeah, well, I would say be open-minded because I think the job market is, we don't know, AI is kind of having a negative impact on entry-level white-collar jobs. So you need to be thoughtful about that and how to navigate that. So I think you need to be open-minded, but preferably if you have options, pick a company that has a good culture. Ask them how they think about their customers. Right, if they're an investment firm and they talk about them like Muppets, you probably don't want to work there. But if they talk about them as
I remember Muppets.
remember
way
Muppets?
Back when, yeah.
Just to mention an example. So I think it's important, any business actually, whether it's finance or any real economy business, how they think about their customers and treat their customers. Because I do think long-term success is based on having a mutually beneficial relationship with your customers. So I would. Just the work ethic, and again, keep an open mind. Sometimes things you weren't even thinking about come up, and they turn out to be really, really good job choices.
And our final question, what is it that you know about the world of banking regulations, government service, financial industry today might have been useful to know way back when you were first getting started?
Yeah, I thought about that. Markets, right? Not personal finance, but market. Well, clearly, credit card debt.
Go whichever way you want.
Yeah. Well, compounding was something I did not understand, and credit card
That
rates.
comes
and
up
those,
surprisingly frequently.
Yeah.
Because it's not intuitive.
Yeah, no, it's not. And the daily compounding is, it racks up pretty quickly. I think for markets, financial markets and investing in particular, I've actually done pretty well over time. My grandmother gave me $1,000 when she was getting later in life, near her death, and she didn't have much, but she wanted to give my sister and I something. So she gave me $1,000 and told me to put it in an IRA. That was back when IRAs had just gotten started. And with my dad's help, I put it in the Contra Fund. It's worth a lot of money now.
Right.
So I made some lucky. I've stuck mainly. I've picked a few stocks, but I've picked mainly diversified index funds of various sorts. And I wish I'd understand better about being brave during the dips, though. I think I usually I buy and hold, so I don't sell when the market's going down, which is the worst thing you can do. But I think I would have been a little more courageous buying in the dips.
Buying more into weakness.
Yeah.
Well, Sheila, thank you for being so generous with your time. As always, a delight. We have been speaking with Sheila Bair, former chair of the FDIC, author of the new book, How Not to Lose $1 Million. If you enjoy this conversation, well, check out any of the 600 we've done over the past 12 years. You can find those at iTunes, Spotify, YouTube, Bloomberg, wherever you find your favorite podcasts. I would be remiss if I didn't thank the crack staff that helps put these conversations together each week. Alexis Noriega is my video producer. Sean Russo is my researcher. Anna Luke is my podcast producer. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.